It's a Wednesday morning, but not just any Wednesday. The air crackles with a tension not felt since 2008. News has just broken. First Republic Bank, a financial institution once considered rock solid, is on the brink. Lines snake around the block, as depositors, their faces etched with fear and uncertainty, desperately try to withdraw their life savings. The rumors start subtly, then rise in volume, a chorus of anxieties. Is my money safe? This scene, unfortunately, is not from a Hollywood thriller but a stark reality that unfolded just a few months ago. The collapse of Silicon Valley Bank in March 2023, followed by the rapid demise of Signature Bank and the 11th-hour rescue of First Republic, sent shockwaves through the global financial system. Suddenly, the unthinkable seemed not just possible, but imminent, a full-blown banking crisis. Politicians, eager to reassure their constituents, offered platitudes and promises, but the damage was done. Trust, the most fragile of commodities, had evaporated, leaving in its wake a climate of fear and suspicion. To understand how we arrived at this point, we need to rewind the clock to a time when the economy was reeling from the aftershocks of a global pandemic. In response to the economic fallout of COVID-19, central banks around the world, including the Federal Reserve in the United States, slashed interest rates to near zero. The goal was to stimulate borrowing and spending, to inject much-needed liquidity into a system teetering on the brink of collapse. This unprecedented monetary easing had the desired effect. Businesses, buoyed by cheap credit, were able to stay afloat, and consumers, flush with cash from stimulus checks and low borrowing costs, went on a spending spree. The stock market soared to new heights, and for a brief shining moment, it seemed as if the worst was behind us. But this sugar rush of cheap money came at a cost. Inflation, long dormant, began to stir, fueled by supply chain disruptions, surging demand, and trillions of newly printed dollars from thin air circulating the global economy. The Federal Reserve got caught by surprise at the level of inflation and reversed course, embarking on an aggressive campaign of interest rate hikes. However, these rate hikes, while necessary, would have unintended consequences, pushing the financial system to the breaking point. The banking crisis of 2023 wasn't merely triggered by rising interest rates, it exposed a deeper vulnerability within the financial system, a dangerous lack of diversification. Banks, particularly regional institutions like Silicon Valley Bank, SVB, had become overly reliant on a narrow band of depositors, in this case, venture capital firms and tech startups. This concentration of risk, while seemingly benign during the boom times, proved to be fatal when the tide turned. As interest rates rose, venture capital funding dried up, forcing startups to draw down their deposits at SVB. The bank, caught off guard by the sudden outflow of deposits, was forced to sell assets at a loss to cover withdrawals, sparking a panic that quickly escalated into a full-blown bank run. The failure of SVB, while alarming in itself, was symptomatic of a broader trend: the increasing interconnectedness and lack of diversification within the financial system. While the initial tremors of the banking crisis were felt most acutely in the tech sector, it quickly became apparent that the contagion would not be confined to Silicon Valley. Small businesses, the lifeblood of the American economy, found themselves caught in the crosshairs, as credit markets froze and banks, fearing further losses, pulled back on lending. For small businesses, already grappling with inflation, supply chain disruptions, and a tight labor market, the banking crisis was a gut punch. Lines of credit, essential for managing cash flow and funding day-to-day operations, were suddenly withdrawn or reduced. Businesses, starved of credit, were forced to lay off workers, curtail investments, and in some cases, shutter their doors altogether. The ripple effects were felt throughout the economy, as consumer spending contracted, unemployment ticked upwards, and the specter of recession loomed large. In the aftermath of the 2008 financial crisis, there was a collective sigh of relief, followed by a solemn vow: never again. Sweeping regulatory reforms like the Dodd-Frank Act were enacted to prevent a repeat of the excesses and recklessness that had brought the global financial system to its knees. However, as the years passed, the sense of urgency faded, and the political winds shifted. The Trump administration, with its deregulatory zeal, chipped away at the safeguards put in place after the 2008 crisis, arguing that they were too burdensome and stifled economic growth. The banking crisis of 2023 exposed the folly of this deregulatory push. The parallels between the 2023 banking crisis and the 2008 financial crisis are striking, if not entirely symmetrical. Both crises were rooted in a toxic cocktail of easy money, lax regulation, excessive risk-taking, and a fundamental misunderstanding of systemic risk. Both crises exposed the fragility of a financial system built on a foundation of interconnectedness and leverage. However, there are also key differences between the two crises. The 2008 crisis was centered on the housing market, specifically the subprime mortgage meltdown. The 2023 crisis, on the other hand, originated in the tech sector, highlighting the evolving nature of financial risk. Moreover, the response to the 2023 crisis was swifter and more decisive than the initial response to the 2008 crisis. Central banks and regulators, having learned from their past mistakes, acted quickly to contain the damage, providing liquidity to troubled institutions and reassuring depositors. Behind the cold statistics and the arcane jargon of financial markets lies a human toll, often overlooked in the aftermath of a crisis. The collapse of banks, the loss of savings, the credit crunch that paralyzes businesses, these are not mere abstractions but events with real-world consequences for millions of people. For the small business owner, forced to close their doors after years of hard work and sacrifice, the crisis represents not just a financial setback, but a deeply personal loss. For the employee laid off from their job, the future is shrouded in uncertainty, their dreams put on hold as they struggle to make ends meet. For the retiree watching their life savings dwindle, the crisis evokes a sense of betrayal and vulnerability, a shattering of the promise of a secure retirement. The human cost of financial instability extends far beyond the immediate victims of bank failures. In the wake of the 2023 banking crisis, a fundamental question lingers in the minds of many Americans. Can we still trust the system? Can we trust the banks with our hard-earned savings? Can we trust the regulators to prevent another meltdown? The answer, unfortunately, is not a simple yes or no. The financial system, for all its flaws and vulnerabilities, is an essential component of a modern economy. It provides the lifeblood of credit that businesses need to invest and grow. It offers individuals a safe and convenient way to save and manage their finances. It facilitates trade, both domestically and internationally, connecting buyers and sellers across vast distances. However, the system is only as good as the people who run it and the rules that govern it. In these uncertain times, it is understandable to feel anxious about the safety of your savings. While there are no foolproof guarantees in the world of finance, there are steps you can take to mitigate your risk and safeguard your financial well-being. Here's a practical guide to navigating the current landscape. First, understand FDIC insurance. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor per insured bank. This means that if your bank fails, the FDIC will cover your deposits up to this limit. Make sure your deposits are held at FDIC-insured institutions. Second, spread your risk. Don't put all your eggs in one basket. Consider diversifying your savings across multiple banks, especially if you have deposits exceeding the FDIC insurance limit. You can also explore other savings options such as money market accounts, certificates of deposit, or U.S. Treasury securities. Third, monitor your bank's health. Pay attention to your bank's financial health. Diversification, a cornerstone of prudent investing, is equally relevant when it comes to safeguarding your savings. Just as you wouldn't invest your entire portfolio in a single stock, it's unwise to keep all your cash in a single bank, especially in times of economic uncertainty. The concept of diversification is simple. Spread your risk by allocating your savings across multiple institutions and asset classes. This way, if one bank fails or one asset class underperforms, your overall financial well-being is less likely to be severely impacted. When diversifying your savings, consider a mix of deposit accounts, such as checking accounts, savings accounts, and money market accounts, at different banks. You can further diversify by exploring other savings options such as certificates of deposit, which offer a fixed interest rate for a set term, or U.S. Treasury securities. In an era of online banking and mobile apps, it's easy to forget that banks are not just faceless institutions, but businesses with their own strengths, weaknesses, and risk profiles. Taking the time to understand your bank's business model, financial health, and risk appetite is an essential step in safeguarding your savings. Start by reviewing your bank's annual report, which provides a comprehensive overview of its financial performance, asset quality, and capital adequacy. Pay attention to key metrics such as non-performing loans, which are loans that are not being repaid as agreed, and capital ratios, which measure a bank's ability to absorb losses. You can also research your bank's Community Reinvestment Act rating, which assesses its record of lending to low and moderate income communities. The banking crisis of 2023, while unsettling, also presents an opportunity for reflection and reform. The financial landscape is constantly evolving, shaped by technological advancements, changing consumer preferences, and the ebb and flow of global economic forces. The challenge for policymakers and industry leaders is to foster innovation while ensuring stability, to create a financial system that is both dynamic and resilient. One area ripe for innovation is financial inclusion. Despite significant progress in recent years, millions of Americans remain unbanked or underbanked, lacking access to basic financial services. Technology, particularly mobile banking and fintech applications, has the potential to bridge this gap, providing affordable and convenient financial services to underserved communities. Another area of focus should be on strengthening the regulatory framework. The banking crisis of 2023 serves as a stark reminder that financial stability is a precious and fragile commodity. It is not something that can be taken for granted, but rather a goal that requires constant vigilance, prudent risk management, and a commitment to sound regulatory oversight. As we navigate the complexities of the 21st century financial system, it is more important than ever to be informed, engaged, and proactive in managing our financial well-being. We need to understand the risks we face, the safeguards available to us, and the role we can play in shaping a more stable and resilient financial future. By arming ourselves with knowledge, diversifying our risks, and demanding greater transparency and accountability from our financial institutions, we can navigate this labyrinth with confidence.